Joining us to discuss major themes he finds investable in this current environment is Steve Tananbaum. He's founder, managing partner, and CIO at GoldenTree Asset Management. Steven's a veteran of credit markets with over 30 years of investing experience, knows a lot from the credit markets to equity markets. I do want to start here with you on a trade that's been pervading markets here. This idea that the banking system is going to face a ton more regulation. They have been saddled with prior investments in credit that were made in a very low interest rate environment, now offloading those assets. Now, what does that look like from your side? So
first, let's look at it from the bank side, which is if you can free up capital. So imagine if you took a loan of $1, and the idea being that you could get the same regulatory capital, even more, if that loan was only if you had on your books had 80 cents and you were able to sell that 20 cents, and you would get more regulatory capital than if you had the dollar on your books. So that's the arbitrage, that they get more capital, it frees up capital. The view from the regulator is, well, the bottom 20%, the bottom 15% is somebody else's risk, the junior part, the most junior part. Now, what the buyer sees is the opportunity to get a very attractive return. And they're usually a pool of assets, so they're commingled together. And what it compares to, probably the best comparison is structured products, where you look at an index or a collection of credit card receivables, et cetera, and that's what or CLO debt, that's what it's compared to. And usually the risk equates to about a triple B or a double B. You get about 500 basis points more of return than a comparable double B, triple B of credit cards, CLOs, et cetera. And yes, it's bespoke, but you're getting paid for the extra work.
How large are these deals? To get a sense of how big they can get, are they sizable for you?
Oh, absolutely. We've done probably $10 billion of face in the last year. And
alone?
Alone, yes, of face. But usually there's a lot of leverage because you're taking the bottom part, the bottom 10 or 20%, so it's much smaller. And then we can get leverage on that bottom 10%. And what we look at the risk would be a multiple of 2008 experience. So we feel like the risk equates to double to triple B, and we're being paid a pretty fair spread over what those other like assets would yield.
Mm-hmm. So we're talking about risk transfers here, and I'm wondering, I mean, obviously you see this opportunity right now. How long will this last? I mean, is this something that is an endurable, sustainable trade that you can do, or is this more moment in time?
I think both. I think that there'll always be regulatory arbitrage. Right now, your premium over alternatives is pretty wide. And I would say we've seen this in other markets. You've seen it in, for instance, private credit. You got very good premium, and that premium's collapsing. And more generic, you can take out the parts of the deal you don't like and keep the deals you do like, you're still able to do. That's going to, my guess is, go away over time. So, and that spread may not be 500 basis points, maybe it'll be 200 basis points. Because it's bespoke, it should be at a premium, because if not, you could just buy liquid, basically tranches of different indices, and that would be the way to go.